The latest union budget brought some changes to taxation, including new rules for capital gains, both long-term and short-term. Taxation for capital gains has increased, and if you buy or sell a property, gold, or mutual fund, these changes matter to you. Here is what you need to know. Long-term capital gains, profits earned from selling an asset that you have held for a period of more than 12 months for financial assets like equity shares and mutual funds, and over 36 months for other non-financial assets like properties, gold, etc. The taxation was 10% for this. Now it is 12.5%. Similarly, there are also changes in holding period. Short-term capital gains, profits from assets held for a shorter period, that is less than 12 months. The taxation for certain financial assets rose from 15% to 20%. The most notable change comes in the form of removing indexation. Indexation adjusts the purchase price of an asset for inflation, making the tax on capital gains fairer. Previously, you would pay 20% tax on capital gain after adjusting for inflation. Now, the tax is 12.5% on the full gain without inflation adjustment. For example, if you bought a property for 100 rupees in 2005 and sold it for 1000 rupees in 2024, indexation would adjust the 100 rupees to account for inflation, reducing the taxable profit. To calculate indexation, cost inflation index is used. It is a formula used in the calculation of an estimated yearly increase in an asset's price as a result of inflation. In this case, the cost inflation index for 2005 was 117 and for 2024 it is 363. So let's take a look at two scenarios. Scenario number 1 for a high profit sale. Selling your property for 1000 rupees while you bought it for 100 rupees. With indexation, you would pay 20% on 690 rupees, which amounts to 138 rupees. Without indexation, you pay 12.5% tax on 900 rupees, which is the full profit. This comes to 112.5 rupees. Here, you pay less tax under the new rule. Scenario number 2, a sale with a low profit. Let's say you sell the same property for 500 rupees while the purchase cost was 100 rupees in 2005. With indexation, you would pay 20% on 190 rupees, which is the profit after adjustment. This amounts to 38 rupees. Without indexation, you would pay 12.5% on 400 rupees, which is the full profit. This amounts to 50 rupees. In this case, you end up paying more tax under the new rules. This shift has sparked a debate among taxpayers. But what does an expert think about these changes?
If you take, for example, the last 4 years, the cost inflation index on an average has been just 5.5%, right? So one needs to, first of all, understand whatever your tax from here on is based on future cost inflation index, not the past. The past will come into play, but there will also be future years with lower inflation, which means your indexation will not be as high as the past years. So that's something to keep in mind. For example, if you had bought property in the last 4-5 years, your average inflation index was just 5.5%, which will likely continue. So you're not going to enjoy a big indexation benefit. Second, if you had bought a property, typically, I mean, for investment and you're holding it for 20-30 years and selling it, or a land, if you think you have not even made gains of 10%, right? The problem about 10% in most cases, your new taxation will actually help you. Okay, when I say 10%, 10% annualized return, right? So instead of saying 3 years, 3 times, 4 times, what matters is over what period you are getting that returns. If a property has not even delivered that, the problem really is you have not made much money on the property, right? If you had made much money on the property, actually your 12.5 tax is more useful than a 20% indexation. So that people need to understand, when they instead of having a very myopic view of taxes alone, they should step back and understand if they have actually not paid taxes or on something and they are in losses, it means their investment was bad. This has got nothing to do with taxes. So we need to take a holistic view, in my view, of this whole thing of simply saying, I'm going to pay more taxes.
When it comes to equity and mutual funds investment, what are all the possible changes? What should one calculate before making an investment decision?
your short-term capital gains from 15 to 20, I think it is okay. People should look at equity as a long-term asset class, as a wealth builder. So there, that slight increase, it is an increase. It will cost you more now to, shell out more tax if you sell within a year. But I think that is okay, right? Because you're fostering a culture of holding for a longer period. On 12.5, 10 to 12.5 is a marginal hike. We should see it in conjunction with the fact that the overall capital gains exemption limit for equity has also increased from 1 to 1.25 lakh. So net, it is not a very bad thing in the first place. In equity, long term will become 10 to 12.5. Equity mutual funds and stocks both will become 10 to 12.5, which is marginal. What I'm saying is you should look at it together with the increase in exemption given for equity mutual funds and stocks together, which is 1 lakh to 1.25. That is, if you made any gain up to 1.25 lakhs in stocks and equity mutual funds put together, you will not have any taxes.
In short, one could argue that the new tax rules benefits those who sell their property at a higher profit and affect those who sell their property at a lower profit.